Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning. I hope you had a great weekend. This is Peter Lewis and a warm welcome to my podcast Money Talk for Monday the 24th of April. In today's business and finance headlines, President Joe Biden aims to sign an executive order in the coming weeks that will limit investment in key parts of China's economy by American businesses. Flash April composite PMIs from the US, the Eurozone and the UK all beat expectations in data released Friday. Chile's President Gabriel Boric said last week that he planned to nationalise the country's lithium industry. Chile is the world's second largest producer of the metal, which is crucial to car batteries and other green technologies. Investors are piling into ultra short-term treasury bills to avoid getting caught up in the US debt ceiling drama.
Money Talk.
I'm joined now by Andy Sher, who is Shanghai-based independent economist. Good morning, Andy.
Good morning, Peter.
Let me ask you first of all about this latest news in the technology war between the US and China. It looks like, first of all, this is going to extend now to investment flows, the US looking at restricting investment flows into certain sectors. And also the Financial Times reporting this morning that the Biden administration is trying to get South Korea to encourage its largest chip makers, Samsung Electronics, SK Hynix, to not fill the gap if there's sanctions put by China onto Micron. This all seems to be a worrying escalation, doesn't it?
Yeah, I think that the US is trying to slow down China's technology development. Will lose the competitiveness in these sectors. So it's trying to get its allies to work together on these. But I know it's really I think that it's not going to work out eventually. What I have seen is that it appears that it's really focused the country's attention on breaking through these restrictions. I think there are a lot of people, and China has a lot of money. And if you think the Chinese just dumb, couldn't do that without foreigners, and I think that assumption is probably not robust.
So do you think China will ultimately be able to develop its own semiconductor industry? As the problem seems to be it doesn't have the equipment, does it, to manage, to manufacture the advanced chips. But could it develop its own equipment? Could it source that equipment domestically?
Yeah, it's developing its own equipment sector. But the issue is that it takes a long time because the supply chain, the components supply chain is very long. It's even if for one machine, it would require like maybe 500 suppliers, and these suppliers are spread around. Like in Japan, Japanese still good at some precision components and so forth. So it's not just the equipment itself. It's you really need to pull in all the whole supply chain. So it takes time. It takes time, but it's this is basically it's basically time consuming. But if you put your mind to it, you can do it. China is big enough to do everything together at the same time.
And what do you make about this news of new controls on outbound US investment to China that the Biden administration is talking about imposing at around the time of the G7 summit later next month in Japan? What sort of impact will that have?
Well, like this semiconductor equipment thing, it could have an impact, but it just slows down China's development somewhat, but it's not likely to stop China. This is really about what happened to this commercial jet. China is developing the equivalent of Airbus and Boeing jet, and it looks like it's working, and it came through many JVs with many component suppliers. But obviously this JV process did help, but it doesn't mean that in the future China will will be totally dependent on these JV suppliers, because Chinese technology level has really is really making some tremendous progress in the last 3 years, as far as I can tell, in terms of manufacturing process, in terms of like EV. It's like basically a generation of people after making things, looking at how the technology how technology works. What I see is that a whole generation have matured and can do a lot more. This is just what has happened to like infrastructure, to the earlier stage of development and so forth. Basically, you have a generation doing something, and first initially at downstream, and making things. Then you walk back upstream, and eventually you figure out how everything works. And what I see is that in the technology space, this is what's going on.
And what is the risk then that the global economy is just going to split into two blocks? It's a fear that the IMF has, or the World Bank has, doesn't it? That you're going to have this China-centric block and then this US-centric block, which will be very damaging to global growth, wouldn't it?
Yeah, basically we're moving towards two prices. But the issue is that we're going to have a G7 price, and we have a global South price, which comes from China. And you look at the EV. China now is making an EV. The BYD is selling EV for about $11,000 and that goes for like over 200 miles, about 260 miles. And anywhere else you find something equivalent that will cost twice as much. Mm-hmm. So this is what we're talking about. It's clearly in the EV space, because the U.S. is using subsidy to encourage local production. But the end result is that the U.S. EV will cost twice as much as China's EV.
So this is going to be very damaging then for the global economy overall if that happens. And as you say, we're going to end up with dual sort of pricing structures for key products.
Yeah, I think that eventually the G7 would obvious high price slows down growth and boosts inflation. So that's something I've been writing about. We're going to have a global South. We'll have a different potential growth rate, and I think it's probably around 5%. I think the G7 is likely headed towards zero growth and inflation.
And maybe into recession. Do you see the US slipping into recession?
Yeah, it is, but it's going to be a full employment recession. It's basically because the U.S. the global labor shortage is all around and it's structural. So the recession has to come from profit margin going down and shrinkage in capital expenditure and some reduction in fiscal deficit. The demand reduction will probably come from these three sources. But labor has bargaining power because of the labor shortage. So wages will go up, and will try to catch up with inflation and some. So the central banks who are hoping that a mild recession will bring down inflation, they will be surprised.
So let me ask you then about China's economy. We had the GDP data last week. GDP grew 4.5% year on year. Retail sales were particularly strong, rising 10.6% year on year in March. What's your assessment after seeing that data?
Well, I think that the market thought it was stronger than expected, and the financial market doesn't make much sense in terms of predicting the economy. What I see is that I wrote at the beginning of the year that China would have 5% growth rate, but that 5% is quite weak because the base is very low after 3 years of a pandemic. The base is at least like a -8. So if anything below that is kind of not even filling the hole. So -8 is from the last 3 years. You're adding the potential for this year. It's about a 12 to 13%. So obviously growth rate is very very anemic compared to that, to what you could do against what you are doing. The reason is because Chinese households really lost income during the past 3 years, and the savings stock kind of declined. So they need to rebuild. This is a very important element in slowing down the recovery of the service sector. Then we have the property sector that is really just beginning to restructure. It takes a long time, many years, for the property sector to normalize. And these two factors are keeping Chinese economy below potential.
And the authorities seem to be quite worried, don't they, about the consumer sector? They don't seem to be satisfied that it's strong enough. You mentioned the reasons why.
Yeah, you have to wait for wages to rise, for people to recover their balance sheet, and it takes time. And there's no point of hurrying on.
Let me ask you about the unemployment rate, 5.3%. But the thing that stood out was the youth unemployment rate for those aged 16 to 24. It's 19.6%, almost 1 in 5 young people out of work. This is a huge problem for China, isn't it? And it doesn't seem to have a solution to it. It was basically on Friday blaming graduates for wanting to have professional jobs rather than taking on manual labour.
Why too many people going to college these days? Over half, 50%, over 50%. China is a manufacturing economy that doesn't need a lot of college graduates. So everybody wants to be a financial guy or internet guy. Both bubbles are deflating. So and during the meantime, we have a severe shortage of manual labor, both factory level or the service sector. So we do have a mismatch, and it's an aspiration issue. So I don't know how this is going to work out. A lot of kids who couldn't pass the college exam, then they try again and they try again, and they get their mother to stay home to kind of cook for them, and so that they think that helps. So we have 2 people staying at home for many years because this kid wants to go to college.
So you think,
and if you fail a couple of times, maybe you get the message. Even half of the people go to college and you still fail a couple of times. Is it worth it?
So you think the government may be right then that, graduates have got to maybe for a while put aside their professional ambitions and be prepared to take on other jobs?
Yeah, but what are they doing? They're bidding down the entry-level white-collar jobs, bidding down the wages to 3,000, 4,000, basically not getting paid, compared to construction worker getting paid over 10,000,
Andy, it's always very good to talk to you. Thank you very much indeed. That's Andy Scher, Shanghai-based independent analyst. Thank you very much for listening this morning.
Money Talk